guys, that is the 15-minute break conclusion. We will now be getting back to page 443. 443 in the workbooks is progressive exposure. After this, we will take a 5-minute break. This section should last just about an hour and 15 minutes. So let's get back to Mark and Mark for progressive exposure, page 443.
Okay, welcome back. We're going to move to page 443. We're in the risk management section in the second workbook. I know there's been a lot and it may be overwhelming, but bear with us here. There's still a lot more as well. But again, these are things that you really not only you need to know, but you need to study and you need to work on. And this is really what it's all about. This section really brings it down, and we're using a lot of examples to illuminate points in many different ways to hit you from every angle. So we really make sure that you're getting this. And because sometimes one way we say it, one person understands it, but then you got to say it a little bit differently or show a different example, different metaphors, and so forth. What we're going to get into now is what we call progressive exposure, and also having you understand that trading is not an on or off business. It's not just a green light on, red light off, where the market's, it's a buy signal. I know we get into these buy and sell signals that, we've got these services and these indicators and so forth, buy, sell, but there's a lot of there's a lot of gray area in between, and what we found is the best way to trade is to trade incrementally, and we're going to show you what that means. And also, this is a big part of managing risk. So the first thing you want to always realize is that you should always think in a small success leading to big success, meaning that let your smaller trades give you the direction as to where you should go with your larger trades. So whenever I get back into the market, and again, this is a perfect example, you're in a tough market, you're in a bear market, and I'll just ask you, Mark, if you're in 100% cash and you're in a real difficult market and maybe you haven't been doing that well or you've been out for a while, all of a sudden you start seeing some VCP setups. Are you coming in and just going hog wild and putting your whole account in a couple stocks and taking big exposure right off the hop?
Absolutely not. The idea obviously being, which we're going to get into in this section, but, you have to jockey for position and gauge the health of the market and by sticking a toe in first. It's the same old analogy of, do you want to just jump in the deep end of the pool without checking the temperature of the water first? That's a recipe for volatility in your returns that you don't want if you do that. That's sort of the cowboy mentality, where the real professional mentality is to start at the other end and test the waters first, and only really get aggressive when you feel like the timing, and everything is correct, which we'll get more into.
Yeah, and taking the temperature is a great a great metaphor or analogy of taking the temperature of the market, taking the temperature of your strategy, of whether things are working or not, the stocks are breaking out. And remember, we want to look for those confirmations, violations. So when Mark or I go back into the market, even David Ryan would tell you the same exact thing. Bill O'Neill would tell you the same thing, that we're gonna take a few small trades and start off with some smaller exposure. Usually I'll go in with about 25% exposure, will be sort of my first toe in the water. It may be 25% position, and maybe 5% positions, depending on what I'm seeing in the market, if there's a lot of stock setting up or not. But I'll put that proverbial toe in the water and take the market's temperature. And this also works mathematically. I'm going to show you how the math works. And this is what we call financing risk. We're always looking to finance risk, improve our worst case scenario, and always maintain mitigating that downside. So again, when you first go into market, it's all risk. You have no profits to work with. You don't have any cushion. It's all risk. So you incrementally want to move yourself into the market. And So let me show how this, let me give you a few hypothetical examples of how this would work. So say your first trade, you've got a 4% stop, okay? And it represents $1,000, right? And so you're a 2-to-1 trader. We're just going to use 2-to-1 and say on average, you're 2-to-1. So if you had a winning trade, it would average 2,000. So we'll say that you made $2,000 on this trade. It was a winning trade, right? So now you've got $2,000 that you've banked, and you've now financed 2 more trades. If you went and used that same risk and you backed into another trade, and say another trade comes out of a VCP and you use a 4% stop, well, now if you lost in that trade, you would lose $1,000, and you still have $1,000 for another trade. So you're financing your larger size, or you can double your size. If you doubled your size, now you would, if you lost on that double size, you're going to be right back to where you were, no loss in your account as far as from your starting capital, your principal, and you've financed a larger amount of risk. Like I said, this is what we call progressive exposure. And this is something that Mark and we do just axiomatically, automatically. We'll constantly gauge by using test positions. Now, once we get some feedback and trades are working, then you can jump to larger positions and you can start trading at a larger exposure. But here's the thing that you have to remember, and again, this works in the opposite too. Okay, Mark, if trades start going against you, let's just say you came in with, I don't know, 10% position sizes, you took a couple of them, and you get a bunch of losers in a row. Now what are you doing? What are your next trades going to be?
Smaller.
Yeah,
absolutely. I think of it, in terms of, just like we talked about those sliders before. It's a sliding scale in terms of that feedback in the market telling me, either more aggressive, more conservative. So if I come into the market and get whacked, I'm not coming back in with the same size. Because again, even on a portfolio basis, I want to wall off that left side in terms of the drawdown. So if the market is, I know the criteria is good, but I'm losing, I know the market is bad. The only thing I can control, is my sizing at that point.
Right. So let me give you another example here of how progressive exposure works and how you would scale yourself up, and then you would even scale yourself back down. So now let's just say your position size, your maximum position size that you're willing to risk would be 25%. 2-to-1 trader, that actually is your mathematical optimal position size, would be 25%. So that would be where you're trying to get to. You're trying to get to your bigger positions being 25%, but you're just getting into the market. So you take a quarter position, right? Which would be 6.25%. You risk $500. Okay, but that you win. You win 2-to-1. You make $1,000 on that trade. All right. Now you can bump your size up. Right. You double your size to 12.5%, and you're risking now $1,000 because you've doubled your size. Well, let's say you get 2 trades in a row that are winners, and that's now a $2,000 because you risked 1,000, 2-to-1, $2,000. Right. Now you've got $3,000 profit. You can now move up to that full position. And even if you lose, you would still have $1,000 left over and be able to move to a half position, which you could scale back down. Now that things aren't working, you lose on your big trade, you can scale back down if you'd like. Even if you kept it the same size, you're going to lose less than you originally risked, because now you've got $1,000 more to work with. So this is how you would expose yourself. Now, the reason why you do this is because you want to pyramid yourself into trading your largest when you're trading your best, and always be guaranteeing yourself to be trading your smallest when you're trading your worst. And the only way to do that is to bend with the market, is to bend with the results. So when things are going well, you step it up. When they're not, you bring it back. What happens is, yes, sometimes you bring it up and then things go bad, and you bring it down, and then it starts going well, and you wish that you did the opposite, and you got really aggressive when things are bad. You can go back in hindsight and Monday morning quarterback. But the bottom line is that outside of that noise and those short-term back and forths that you're going to, as Mark said earlier, jockey for position, you are going to guarantee yourself that when things are going really well, you're going to be having big size on, and you're going to be making big money in the bull market. And when you go into the bear market, you're going to guarantee yourself that you take your size down until it's negligible, and you are going to be in cash or near cash, and you're never going to get yourself in trouble. And this is the reason why I've participated in every bull market in the last 9 bull markets in 30 some odd years. And I've never been caught in a single bear market, not one single time, having heavy exposure, because I bend. I progressively expose up and I progressively expose down. Mark, in the years, the 13 years that you laid down these great returns, have you ever been caught in a big downdraft, even one single time?
No. For this reason, and I think this is really, just go back to that last slide real quick, just to make it really simple, because one question we get is, well, why not just go in big right away? You're going to be there, you'll eventually be there when things work, and well, that's true, but the reality again is these periods are not evenly distributed. And so if you think of it in terms of, if you're a 50-50 trader, it's not always win-loss, win-loss. You have these runs of wins and losses, and you want to use that to your advantage. So if you look at it, in this case, if you use progressive exposure properly, and one trader does exactly like the slides here say, trade 1, 2, 3, versus just starting at trade 3, risking $2,000, who's going to wind up? They're both going to be trading big. It's going to take the one who does it in order a little bit longer, but they're going to be risking a quarter in order to finance the ability to get there, versus the other one who just goes in big every single time. And the volatility in their trading is going, again, to the point we were saying before. You would think there's this massive difference. It's often smaller than folks think, and learning how to do this properly. And I've heard many of Mark's students over the years say that this lesson has made the biggest difference in the long run in their trading, understanding and learning how to do progressive exposure properly.
Yeah, in almost all the cases of all the really successful traders that we've trained, progressive exposure is always mentioned as one of the main things that changed their that made them successful and changed their trading from being mediocre to being outstanding, is understanding this and applying it. Now, a couple things I want to say. Again, starting, as Mark said, starting right out and coming out with big positions. Well, you can, in hindsight, in this example, yeah, that would work. But what if those first couple trades, or all 4 of those trades, were losers? Now you're in the hole. And this goes right back to the previous example of losses work geometrically against you. So what happens when you get into the hole and you're down 20%? It takes a 25% gain to break even. If you're down 50%, it takes 100% gain to get even. So now you're allowing the losses to get you in a hole, and now it's going to take you more work to get out of that hole. That's why you have to protect the downside. You can't go into the hole too deep, or it's going to take much more work, because losses have a bigger impact on you. So that's the real reason, is because losses work geometrically against you, and that's why you have to mitigate the risk up front. Yes.
And you brushed over this briefly, I think, in one of the previous slides, the idea of always trying to improve your worst case scenario. I think people have to really think through, what does that actually look like in practice? Well, this is what it looks like right here, because the worst case scenario is you just get clobbered on trade 1. Or maybe you go into 4 trades and then wind up losing. Well, who's improved their worst case scenario? If you use this progressive exposure and you get hit on the first trade versus coming in with big size, you lose a quarter the amount. And if you scale up properly and then everything gets hit, your P&L is at 0, where somebody else is now negative. That's improving the worst case.
Another great point, Mark, and that leads to something that is really important to point out, is that what we're doing, not only do we always want to improve our worst case scenario, but we want to improve our potential. We want to increase the potential for reward. So as Mark, what he's saying here is that we're increasing our exposure, but while at the same time reducing our risk. So we're creating asymmetric leverage. and moving ourselves into a situation that is low risk to maintaining a low risk downside, but increasing the upside. And
That's
then
that's a gold mine, not just a gold nugget right there.
it is. It's everything. It's the whole ball of wax. It's what it's all about. Let me show you another example here. And this is where financing, where as you use progressive exposure, you're financing your future trades. As I said, small success leads to big success. And what you're trying to do is create profits, so then you can increase. You want to increase your size. That you want to get to when the market's good. You want to increase your size. That's what differentiates the great traders from everyone else. Is that someone like Mark, myself, when we see the whites of the eyes, we're unloading the mag. We're putting the pedal to the floor, and we're making lots of money when times are good. And that's, we don't have to have very long good times because we're getting so aggressive at that time, but we're never doing it just haphazardly or taking a lot of risk. We're always doing it on the backs of prior success and financing that risk, those bigger positions. So here's again how it would work in real life, where let's say you do have a market that's improving, and you start off with a small position, you make a profit, you make $1,000, you bump it up. You bump your position size, your next size to 12.5%. You double it. You get another profit. You double it again. Now you get a little win streak. You got 3 in a row. Well, what you just did is you just financed by going from 6.25 to 12.5 to 25%, and very incrementally and slowly taking small risk to larger risk and financing it the whole time. You're only at real risk of principal on the very first trade. You've now financed 3 full positions and a half position. You can and you could take those one at a time, or you can go into almost a fully invested position. Now you've just financed an 87.5% a total exposure with 0 risk of original principal. And now you can get very aggressive. And again, if you get hit on all those trades, you might lose on all those trades. You go back to break even. But see, you're never going in the hole where you have to dig out of that hole. And this goes back to one of the chapters in my second book, where I say you want to compound money, not mistakes. This is where you improve your worst case scenario. You lever yourself up to taking larger size and having higher potential, but never with taking more risk. This is really what professional trading is all about. So we want to let profits finance our risk. So we start with relatively small positions. These are what we call pilot buys. And these act as a couple things. One, we're trying to build up some profits, so we now can use those profits to finance the larger risk. But we're also getting the feedback. We're getting feedback from the market, and we're as Mark said, we're taking the market's temperature. And that's letting us know if we should even indeed get more aggressive. We're not going to just get more aggressive just because we took a trade. We've got to see that the strategy's working, the breakouts are working, the market is rewarding our strategy right now, and we're not going to get aggressive unless we get that feedback. All right. So once we do get that feedback, now we've got the profits to finance the larger risk. So, and this goes back. A lot of these things will go back to Bill O'Neill or David Ryan and I talking about these in previous master trader programs and in my books. If you're not trading well at 25% or 50% exposure, and the trades aren't working, why in the heck would you ever bump your positions and your exposure up? Why would you ever go to 75% exposure or 100%? If your 6.5%, 6.25 quarter positions aren't working, why would you ever put on a full position at 25%? Unless you're a glutton for punishment and you want to argue with the market. But this is precisely what people do. They revenge trade because they start off with these big positions, they get themselves into trouble, and then they want to get it back too quick. And before you know it, that chart that is so basic and so remedial of losses working against you is everything. It's everything. When you get yourself in the hole, now it takes way more work to get out of the hole. All right, let's move on to talking about the priorities, because when you first get into a trade, what this is basically bringing us to is that your first priority in a trade is to manage risk and mitigate it as much as you possibly can, because it's all risk. You don't have any profits. You have no history of success. You have no feedback from the market that trades are working. So it's just all risk on the table. So you want to mitigate that as much as possible. You do that with position sizing and your stop loss. But now, as the trade progresses, all right, and the trade becomes profitable, well, now your priorities shift, they change, and you have the option to change your priorities. So now, as the trade starts becoming profitable, at some point, now you want to start protecting your break even, because now the trade becomes risk free. If you protect your break even, and the worst case scenario, this is what Mark was just talking about before, improving your worst case scenario. You want to always look to improve your worst case scenario. Now, if you do it too quick, you choke the trade off, right? So you can't improve it too quickly. You got to give the stock some room, right? Stock, you're setting an 8% stop. Well, until you get a decent profit, you're going to stick with that 8% stop. But now let's just say you're a couple times your risk, all right? Well, you don't want to now take a nice profit that you've taken the risk, you've given the market its shot at you, and taken that risk, and now you've accomplished the goal of making more than you've risked. Well, now at the very least, you want to protect your break even. So now if you do play it for a bigger move and it turns around on you, you're now not taking a profitable trade and turning it into a losing trade. So now that's your next priority. But then let's say you're fortunate enough to have the trade move up even more, and now you really start getting a nice, really decent profit. You're a good multiple of your risk. Maybe you're above your average gain. Mark, if our average gain is 10%, and we go into, on my next trade I go into, and the stock goes up and it's up 15%, what does that do? If I sold that, what does that do to my average gain?
It improves it.
Right. And that's the goal, right? The goal, remember, again, everything we talk about previous, we're building upon. The goal, if you remember, is to get an idea of what that average gain is and optimize it. Get that average gain as large as you can. All right. On average, if you can have 10% gains on average, well, if Mark averages 15% gains on average and I average 10, and we're both 50% right, and we cut our loss at 5%, he's going to do better than me, right? So we want to improve that. The only way to improve that is to take profits above it. So now that is your next metric, where now as you start to get above your average gain, you've got a multiple of your risk. Let's just say you're 4 times your risk, right? You risked 5%, you're up 20% now, but your average gain is 10. Well, now you're 2 times your average gain and you're 4 times your risk. So now you want to go into your priority changes again. You go into the profit protection mode. Now instead of protecting your loss, which you start off protecting a certain amount of downside, then you protect your break even. Now you're going to move up and protect your profit. And this is where a lot of traders go wrong. They'll get a decent profit, but then they'll let that profit come all the way back down, and in many cases turn into a loss. And that's a cardinal rule, which we're gonna move on to right here, is never let a good size gain turn into a loss. Now, good size, decent is a relative term. Depending if you're a day trader, a good size gain might be 2%. If you're a long-term investor, it's going to be a lot larger. When you get above your average gain, and especially if you're multiples of your average gain, you're at a decent gain because it's improving your numbers. That's moving the ball in the right direction. That's getting the ball down the field and getting closer to the goal line, which is to optimize that average gain. So as you get above that, that's where you don't ever want to let that turn into a loss. You really want to protect it and not even really let it go below your average gain. But that might be a little tight. If you're up 12% and your average gain is 10, that's not a time to be protecting your average gain, maybe because it's so tight, it doesn't allow for much fluctuation. But you're up 30%, you certainly don't ever want to let a 30% profit turn into a loss. I mean, Mark, do you ever do that? I mean, would you ever let a 30% gain go into the losing column once you're at a 30% gain?
No, I don't believe I've come to my knowledge. I can't think of a time that's ever happened. And the way I often think about it is the more extended I get from that average gain, the more I don't want to let that dig back against me, or the more I'm going to start potentially either taking pieces of the trade off, because as Mark was saying, that's what's going to improve, or in my case, over time, sustain that really good average gain, and keep that relationship intact, where, I often will sell a piece and then move the stop up sort of in combination to make sure and ensure myself that I'm not going to let that come back too far against me.
Right. Now, we've shown you a lot of tactics and given you tools and charting and so forth, but a big part of this, probably I'd say the most important part, is changing the way you think, changing the way you look at trading, losses, the math, and what you're aware of, your awareness just as in general, of what you're going to look for a stock and your selection criteria. But I'm going to give you some tactics here, or techniques, some position management techniques. But there's a million ways you can do these things. There's all kinds of permutations. All right, but it all comes down to the mathematics behind it, and improving your worst case scenario, creating what we call asymmetric leverage. This is a term that Larry Height loves. He always talks about asymmetric leverage. We've had so many conversations about creating asymmetric leverage, and this is what very successful traders are great at. All right, they're not just great at finding charts and breakouts. That's sort of just first base, to find the charts and to have the skill to be able to see a pivot point. Almost anybody can do that, but doing this stuff requires discipline, awareness, work, self-reflection, study. These are the things. This is why everybody doesn't do this, because this is the stuff. And I'm going to show you a couple of things here. We're going to talk about a few techniques here and a few ways of looking at trading. And then from there, I think it'll open up the options that you'll have going forward. So there's not only do these techniques and tactics protect your math and your profits and create the asymmetric leverage, but there's another thing that you have to protect, and that's your confidence, especially when you're new. Because if you go into the market and you start getting torpedoed right away, you're like, this strategy sucks, I suck at it, it's not working, and you'll abandon it, you'll quit, you'll change. So you're always protecting your confidence too, because you got to have the confidence to go in there, to be able to have the conviction to, when you do see trades working and things are working well, you go in there, take those big position sizes, and you make a lot of money. And when things aren't going well, you cut those losses, and you have the conviction to do that, to do that effectively, and to move up in size. Mark, you started off trading, few, small lots, tens of thousands, and now you're trading tens of millions. So, I mean, the pressure that comes with putting on a multi-million-dollar position is obviously much more than buying $10,000 worth of stock, right?
Well, in terms of dollars, maybe, but that's not how I think about it at all. Because to, your point in terms of confidence, when you are, again, in a situation where your confidence is intact because you're doing all these things properly, I don't want to say the dollars become irrelevant, but that impact is very minuscule in terms of what it has on you, because you know what to expect, what the amount of risk you have, and everything is acceptable within your metrics, and then the overall risk to your portfolio.
And you went right where I wanted you to go. And that's why Mark Ritchie's Mark Ritchie. You see, because I knew he would say, well, not really. I'm taking big positions, and it's not freaking me out, because of all these steps, and all this risk mitigation and all these techniques and tactics. You see, his confidence is intact. He's able to take these big positions, but a lot of people aren't. They start off trading, and then as the trading gets bigger, all of a sudden all the decisions change, because now that dollar amount, now they got a $10,000 profit. Instead of just equating it percentage wise, they're thinking what that $10,000 buys, and now it's affecting them emotionally. And this is where all this, having all these tactics, understanding the math, having all this understanding is what creates the discipline, is what creates, and the tactics is what creates a great trader that can grow. Because to make a lot of money in the market, you obviously got to grow, and you've got to be taking bigger and bigger size. When I first started, I was buying 5 shares, 10 shares, 50 shares. 50 or 100 shares was a big position, and I was buying $4 stocks, $10 stocks. Now today, there's times where I take a $10 million position in my personal account, which, and to some people that's small. There's investors out there that take $100 million position with the same type of calmness and certainty that they would if they're taking a smaller position. How do you get there? Rules and having the tactics and being able to plan for the worst case scenario, improving that worst case scenario. So, all right, I went enough on that. Let me show you some of these tactics. So the first thing, and what I just sort of automatically do, if I get unsure, if the stock starts moving against me and I think, I should sell here for whatever reason, I usually just sell half. If the stock goes up and I'm at a big profit and I'm like, man, I really want to take this profit. I think it's going to go higher though, but I'm really just torn. I usually just sell half. And the reason why is because selling half is a psychological win-win. Regardless of what happens, you are right on both sides of the trade later on, after you make that decision. So if I sell half, if it goes up from there, I say to myself, poof, thank God I held half. If it goes down, I say to myself, whoa, thank God I sold half. Either way, I'm equally psychologically, protected, if you will. Now, if I sold 75%, I would be more wrong than right in one direction or the other. But when you sell half, you're equally protected regardless of what happens. So it's sort of a middle road. Okay, that's sort of the starting point that I want you to understand, of just putting yourself in a psychological win-win. Now, once that stock goes up, the next way to put me into a good psychological position is to then move my stop to break even and free roll the trade. Free rolling just means that you are now risk-free. You've de-risked the trade by moving your stop. All right. So there's several ways to de-risk the trade. One way is to move your stop up to break even. So now the stock comes back down to break even. You're not going to lose any money of principal. So that takes a lot of pressure off you, right? That takes a lot of the pressure off you. Another way that you can free roll is now if the stock goes up, if it goes up the amount of your stop, if you sell half of it, you have now financed your stop. So now you can allow the stop, the same stop. If it's 8%, stock runs up, you take off the amount that you have in risk, and you have now financed the risk. This is what we call financing risk. And once again, you have now de-risked the trade to where the trade is a free roll. The difference in this free roll scenario is that you now can allow the stock more room, but you traded it off because you only have half a position size. So you can't have your cake and eat it too. If you want to have completely de-risk the trade and keep your same position size on, you move your stop up to break even. If you want to give it more room, and you think it's the beginning of a bull market, might have a tiger by the tail. So you want to have at least some position in it. You don't want to give the whole position up, and you don't want to choke it off. So now you can sell some and you can finance your stop. If the stock goes up, let's say your stop was 5% and it goes up much, much more, it's up 20, 30%. Well, now you only have to sell a smaller percentage to finance the stop. So again, the math, you can play around with the math, and it's just the concept that I want you to understand here. So here's a very simple, example. This was a stock here where I was buying MAXY a while back, way back actually in 2000. So again, stock breaks out here, right? We showed this before. It came from a little low cheat, came out of a cheat, runs up here, and now my original stop was down here. But now I move it to break even, right? Now I'm free rolling. right? I'm free rolling the trade. Now let me give you the example here of how I normally do it. What I normally do is I normally leave my stuff, and Mark, you could chime in. Maybe you have a tactic that you do sort of automatically. This is sort of something that I do kind of automatically, where I usually stick to my original stop until the stock does a couple things. One, I get a really decent gain, and I don't want to give all that gain back. Like I said, if I have a real big profit, I'm not going to let that come all the way back and turn into a loss. So that's one. The other one is, let's say it doesn't do that. It only goes up, maybe it goes up 6 or 7, 8%. It pulls back and goes through what we talked about before, a natural reaction. You're only going to know it's natural after it recovers. Once it recovers into new high ground, you get the tennis ball action. Now you can deem that a natural reaction. Once it goes through the natural reaction and it takes out the natural reaction high, and that gets around my average gain or above my average gain, I almost automatically move my stop to break even at that point. And that's what happened here with this trade. And then from there, as it moves up, then I'll start to protect my profit, either sell into strength and take my profit, or start ratcheting up and protect it. Like I said before, we're gonna protect a percentage of it. So Mark, do you have anything like that where you automatically or there's some kind of rule of thumb?
Yeah, same, very similar principle. You know, if I'm at a multiple of my average loss, I generally am either, if I don't move I'm certainly not going to let that turn into an average loss. So I'm looking to move my stop up at least incrementally, if not to break even. And then the other thing I was just going to point out, though, is this whole section on the idea of financing risk, or and free rolling, say, a second half of a position. This is precisely how, if you want to play something for a bigger move, you can do that with I don't want to say, risk-free, if you will, on the front end, where, one of the classic rules and mistakes people make is they let a losing trade turn into an investment. They buy something, it goes against them, and they think, oh, no, I'll just hold it and let a trade turn into an investment. That's this is precisely the opposite. The only time you want to potentially let a trade turn into an investment is or a bigger, a longer term hold is from a de-risked position. Whereby you finance that second half of the position, or sometimes Mark, he'll sell half and then sell half and hold that last piece for an even bigger move. And each one of these decisions has to stand on its own, but that's how you can play some of these moves out for a longer term move, risk free.
Yeah, and again, Mark, it's fair to say that even from a de-risk position, but also from a profitable position, you're going to,
of course,
even if you're just profitable, you don't have to de-risk it. If you're profitable in the trade, sure, you can stay with it and play it for a much bigger move. But what Mark is saying is, you're not holding it from a losing position. Another thing that Mark said is that I was talking about moving to break even. Mark's even being more incremental, saying, well, at the very least, I'm going to actually move my stop up. So I start off with an 8% stop. The stock moves up now. Okay, maybe even if I don't move it up to break even, he's saying move it up to maybe 4%, and now improve his worst case scenario. See, again, everything that we're talking about is all improving our worst case scenario. We want to start off. Here's a golden nugget here. You always want to start off with a worst case scenario that makes mathematical sense. Okay, right there, your worst case scenario should be a winner. You should have an edge. That's where you start with. You mitigate risks to a mathematical acceptable level. From there, you already have asymmetric leverage. If you're averaging 10%, your losses are 5%, you're 50% right. You already have asymmetric leverage. Your bell curve is skewed to the right. But as the trade progresses, it becomes profitable. Now you want to create more asymmetric leverage. That's how you leverage, is that you bring the stop up, and now you've got that upside, but you've reduced the risk. All right, let me move on. So here's another way that I trade. All right, this is just a hypothetical chart here, but what I'll do sort of automatically many times, and we talked about trading from a load cheat, a handle, right? Pull back buys coming up that right side. Sometimes what will happen is you'll have a load sheet. It'll be a pretty deep base, and the load sheet to get back to the old highs will be a pretty good distance. And let's just call it 20% to get back to the old highs, 15 or 20%. And you're taking 5% risk on your initial low cheat play. And now that runs up, it goes through a little natural reaction, it runs up, and maybe within the base, you are now at a profitable position that is above your average gain, or you've got a multiple of your R's of your risk. If it goes up 15%, your risk 5, you're at 3 R's. There's times where what I'll do is I'll actually trade around my position. That's what they call it, is trading around your position, and I'll reduce, and then I'll look to add back, because now when you're in the base, there's a good chance when you run into that supply, you might be looking left and there's some supply there, and you've gotten a nice low cheat and it's run up. And now that it's very likely that when you run into that supply, you're going to get some pullback. You're going to go through that VCP, right? You still got to go through those iterations and tighten to form that full base. But we're coming off of the low cheat, maybe the third floor instead of the 5th or the 10th floor. On our way to the 30th floor, we've gotten in on one of the lower floors. So now what I'll do often is I'll sell half of my position, and then I will move my stop up. And now what I've done is I've taken some profit, and if it keeps moving higher, great. I still have some position on. I'm free rolling. I'm in a great position now, right? But now let's say it goes through some base building and holds above my break-even stop and sets up. Remember I talked about how as the base is progressing, you're not looking to get the lowest price, you're looking to get the right price. And sometimes a higher price is a better entry. That once the base fills itself out and builds that right side and keeps tightening up, you could get a much higher probability entry and you're still within the base. So now I add back, okay? I add back that position and I move my stop up on the whole position. So what happens is my stop that I moved up from my first half of the trade becomes a backstop of the profit, and my stop on the new trade becomes a stop loss. So now I'm levering up. Once again, I'm improving my worst case scenario. This has financing my risk in conjunction with mitigating my initial risk. This has it all. This is all about I'm creating asymmetric leverage in several ways. Just taking the first part off right there and moving up to break even, I've increased my asymmetric leverage, and now by levering myself back up and improving my stop, I've moved it up even more. All right, let me show you how that looks here. So here's Ford Motor. Okay, you buy it here on the breakout, comes up here, right, and now you move to break even. Now trade holds, right? Maybe you sell half of it here, all right? Or you didn't even have to sell half. You could just move it to break even, and now you've de-risked the trade. Runs up a bit here, and now it resets, sets a whole new base, and now I can even add to my position and move my stop here and put the stop on the whole position now right here with my added shares. My added shares, it's just, as Mark said earlier, each trade, each of these decisions have to stand on their own. So if I were to just go in here, right, if I were to just buy it right here, this is the first time I saw it. I had nothing to do with it over here. Well, this would be a good risk reward decision right to begin with, looking at the chart, breaking out of the VCP, setting a reasonable stop that makes mathematical sense. But now I'm merging them. I'm using that now that I'm levering up. I bought over here. I've improved my worst case scenario. Maybe I took some off into here. I can now add back here and lever up. Or if I didn't sell any of it, I can increase my position size. Maybe I started off down here is where I did that 6.25%, position. I only took a quarter position. Now I can move it up, take a half or a full position. But the whole concept is that even if I'm trading around the position, I'm going in and out, I'm taking an initial position, constantly thinking in terms of improving my worst case scenario and creating asymmetric leverage. I don't know if you have anything to add to that, Mark, but I did do that with Rambus back in '97.
I was just going to add this, that 2 slides ago, and then the Ford example. This is how you can, in one stock or in your account, whether it's multiple setups, this is precisely how you can rack up a big return in a very short period of time.
Yeah, with Rambus, I bought it at it was a new issue, and then it got real tight here. It broke out. It ran up in just 5 days. It ran up over 60%. I sold right into this strength, and then I added it back over here. Now I could have very easily sold a portion of it, and then again add it back here, put my stop, which would have been a normal stop that would have came off of this very nice VCP that would have made sense on its own, but it would have acted as a backstop over here on the other shares, and then add it back and going back to my original shares. Or I could have very easily bumped my position up, held through this and bumped my position up, moved my stop to break even, and now create a bigger position. That's more of a tactic of a Bill O'Neill. Bill O'Neill, he made his big money in building big positions. And like an Apple, he was really great at finding those really big secular leaders and then adding to them as they form base after base after base and building these really large positions. I'm more of a trader. I turn my portfolio over more often, and that smooths out my equity curve a bit more, but you can get there either way. So this is sort of a same thing that I talked about before. I just explained it on a different slide before we got to this slide, but this is what we call the add and reduce. This is where, again, in this tactic, we're adding exposure without adding risk. And that is a real key to understand, because very few people understand or know how to tactically add upside without adding risk. This is one way, and like I said, there's so many ways to do this. And if you come up with permutations and you're good at probabilities and stuff, we'd love to know. We'd love to hear your tactics. If you invent any, there's lots of ways to do this. Shoot me an email and let me know what you came up with. But here's one tactic that I've been using forever. And so again, this is coming off of everything that we're doing here is predicated on the fact, at least for how we trade, is going to come off of either the low cheat, the cheat, or the handle. That's where we're trading off of, or power plays. Everything prior to this, nothing changes. We're not doing this on anything other than the technical trade setup that we've already shown you. So in this case, you've got a low cheat here, right? Or call it a cheat, whatever you want to call it. You get this pivot develops, you got a nice little VCP. So I buy 1,000 shares, right? I buy 1,000 shares at 16.5. I set my stop. I set $1 stop. So if I buy 1,000 shares, I set $1 stop, my risk is $1,000, right? Okay, now the stock runs up. And now it tightens up really nicely. Maybe it tightens up even more. And I build out that full, nice big volatility contraction pattern, and it starts to come out of that tight pivot point. So now I add another 1,000 shares. But in this case, I put $1.50 stop at $17 on the whole 2,000. So again, it acts as a backstop. It acts as a backstop to the already the gain that I already have, and it acts as a stop loss on the shares that I'm adding. So I lever up. I add more shares, but now I've got 2,000 shares with the same $1,000 risk. So I've added exposure without adding risk. Now this has to be married. This has to be brought together with the technical analysis and timing your trades. This isn't something that you just can do in any old fluctuation. And it's best done when the volatility gets even less and contracts, and you get an even tighter entry point. And now you can put that tight stop, which acts as a backstop and initial stop, and now you can lever up again. But again, these are the tactics. And not only is this accomplishes two things. One, it accomplishes giving you bigger size and taking more exposure, so when you're right, that you make more money. But the main thing is that it's doing is it's de-risking. And I'll show you how I did this on an unsuccessful trade that I bought. This was Red Robin. Looking back, it probably wasn't the greatest decision here. It gapped up and had this little short base. Extended stocks that gap up from an accelerated advance are very low probability versus them not being in that position. But I was looking to trade this, and it turned into where, for whatever reason, I started trying to lever it up and turn it more into an investment or a bigger swing trade than just a quick trade. I bought it here and it immediately got profitable, but then it tightened up and you got that nice little couple days here. And I bought it coming out here. So I just put a real tight stop, and that now was a backstop on this little profit and was a stop here. So the stock obviously didn't work out. It turned on me really quickly, but I ended up taking a very small loss. But if it had worked out, I had now created that leverage to have a larger position size on, but I didn't take any more risk. And that's what we're always trying to accomplish. All right. So now the question is, knowing what you know up to this point through this whole risk management section so far, if you were to buy a stock right here, this stock, you're to buy this stock right here, coming out of this VCP, and you set a 6% stop, right? This was your stop loss here. And now, looking back, you sold the stock here at a 41% profit. How would you say this trade? Would you say this trade is a good trade? I mean, obviously, it's a profitable trade, right? You made 41%, you risked 6%. So, but knowing what you know about managing risk versus reward, is this a good trade? Most would say it's a good trade. And it is, and again, like I said, it is a good trade if you look at the final result. But as I said before, you have to see how you got there, right? That trader who bought a stock, let it go down 50%, and then made 50%, made $1 for risking $1, right? There's no leverage there, right? Not getting odds on their money there. But the one who risked 5% and let the stock go up 50% made 10 to 1. So in this case, and here's the general rule of thumb here, is that you want to evaluate your position and risk reward every day. Every decision that you make should justify the risk versus reward. You should always be getting odds on your money. Odds on your money isn't just from the beginning of the trade. It's through the entire trade. So now let's look at this a little bit differently. This stock runs up, okay, and it's up 29% at this peak here. It then pulls back 16%, still holding, well above your purchase price over here where it broke out from. But then it goes up from there, and you end up getting that 41%, right? And sometimes people have a hard time understanding what this means. If you knew you were a seller, let's say that you said to yourself, you own the stock right here, and you said, if this stock ran up and I was up over 40%, I'd sell it. I would sell it. You knew that. Let's say you had that information, or you've made that decision. I'm up 29%, but if I was up over 40%, I'd be a seller. Well, then this would be a terrible trade, because now what you've done is you've allowed the stock to go down 16% to only go up another 8% from where you already were. So it depends on your plan. It depends on what your plan is. Your plan you always have to think about where you're a seller versus what you're risking, or what your potential is on the upside versus what you're risking. And you want to continuously maintain that 2-to-1 or better. In this case, you inverted the risk reward relationship. You started with a 3-to-1. You were at a 3-to-1. You accomplished a 3-to-1. Then by allowing that stock to come all the way back down, you gave up that profit for a 1-to-2. You're laying odds now. So, and this isn't as much of a real life scenario that we can, it's more of to have perspective here and to understand that you should always ask yourself the following questions. Whenever you're in a trade, say, would I buy the stock right now? And where am I a seller? Do I know where I'm a seller yet? Like, if you know where you're a seller, well, that's empowering, because now you automatically know how much you can let it go down, because you obviously don't want to invert the risk reward relationship, right? So if you're not a buyer right now, then why am I holding the stock? Am I holding it for a bigger move? Like, I have the stock right now. I buy it at 10, it goes to 15. I'm up 50%. Okay, would I buy it right now? No, it's extended. It's too far from the base. Okay, why am I holding it? Why am I holding? A lot of people can't answer that question. Now, it goes up 70%. It goes up another, 20% from 50 to 70%. But you go through a 50% pullback. You let the stock come all the way back down, and then you sell it up at 70%. Well, that if you knew that you were a seller there, well, that would have made your decision for how much you should allow the stock to come back down, because you wouldn't want to invert the risk reward relationship. Here's another one. So this is Body Central. This is a stock that I bought. I bought it right here, and it shot right up. I sold it right into this move here. It went up 40%. But again, take a look at the math behind this. If you knew you were a seller, if you said, well, if this stock is up 75, 80%, I'd be gone. Well, then going through a 27% pullback would not be a great risk reward decision, because you were already at a 40. And that would only mean that the stock would go up another 27%. So you now risk 27% to get 27%. You're not getting odds anymore. So you always want to be getting odds. And again, I'm just giving you this to form the way you think and the way you approach trading, where you are always getting odds on your money. So just think about it. If you're a gambler, if you're buying real estate, no matter what it is, if you're always getting odds on your money, if you always have the payoff is always greater than the risk, how could you ever be a loser over time? You can't. And that's why I've been a winner for decade after decade after decade, because this is the only way I think. This is the only way I approach an investment, a trade, anything where I'm risking money. I have to be getting odds. And if I'm getting odds, then I have an edge, and I'm going to win over time. You'd be surprised how few people not only think this way, but can put it into the terms of actual tools and tactics and bring it to real life. But I'm giving you the whole process of starting with perspective, understanding your own numbers, where you are, and then bringing that into your trading. And you will eventually get to this. You will eventually get to where you look at a trade and you can't think of it in any other way. Mark Ritchie can't think of trading in any other way. His brain has been programmed into this direction. It can't be unprogrammed. You can't take away his awareness. He's now aware of the truth, because this is the truth. This math is math. 1 + 1 = 2. Nothing's going to change that. Okay. So once you're aware of the truth and the math and the probabilities, why would you make a bad mathematical decision? Okay. So, all right, let's move on a little bit more here. Holding through earnings. So we're often asked, what about earnings? Will we hold through earnings? This is also obviously risk. This is where you have risk where you can't control it. It's one of those things that you're not able to control. It's out of your control. And if you're going overnight in a trade, anything can happen on a gap, right? You get a bad earnings report, stock opens up down, and we've seen this. We've seen Facebook. We've seen some of the biggest companies. There are no safe stocks when it comes to earnings reports, especially when the market, when the environment turns bad, you start getting a lot of unhappy surprises. This could happen in the very best of stocks. So how do we deal with that? So one is position sizing, right? Which we have not gotten to position sizing, right? No, we haven't talked about position sizing yet. So we'll get to that in just a minute. One is position sizing, right? If you position size correctly and you're not having too big positions, well, then that mitigates some of it. The other is having some type of profit, right? Going into the trade. Once again, as we talked about before, when you're profitable in the trade and you've got some cushion, now you finance some of the risk. So now that stock comes down, you've got some profit in it. Maybe you've taken some of that off. You've de-risked it. So the stock goes up 8%, you sell half of it. You've now financed an 8% loss, but you're up 8%. So you financed a pretty good drop in the stock, 15% drop or so you financed. The other thing you can do, and this is where some stocks don't have options or they trade very thin, but certainly in the stocks that are trading, the more active, they have more volume, you're gonna have options on them, you can use implied volatility to get a pretty good idea of the type of volatility to expect of what may happen on a gap. It's not perfect, but with, like I said, with the stocks that are trading volume, you get a really good idea. You'd be surprised how close and accurate it is. So the way you do this is you find the closest strike the closest strike price at the nearest expiration, and then you add the ask price of the calls to the puts, and then you simply divide that total by the current stock price, and that's going to give you a number and will tell you what the stock will move in either direction. So in this case, you've got a $162 stock price, right? Strike is 160. The calls are 3 by 350. The put is 250 by 275. So you're going to add it together. You're going to divide 6.25 by 162, and then you just move the decimal over, times it by 100, however you want to do it. And now you're going to come up with that 3.86%. That's what that stock is. The implied volatility says it's going to move in either direction. I've been wanting to come up with a calculator for this. I don't know if anybody has a calculator to do this, but it'd be a good idea to do. It's a little complex because, like I said, some of the stocks don't trade, or they're sporadically, they only have monthly options. So again, it's got to be taken somewhat. There are some caveats to it, but let's just take a look at some examples of stocks that, you know, they break out of bases. You get that profit cushion, and now we are trying to get. I mean, Mark, do you want to go through an earnings report if you can?
You mean ideally?
Yeah, ideally. I mean, would you like to try to go through and get that potential pop?
Well, certainly, if I have a cushion.
Right.
I mean, that's just sort of baked into my thinking. You know, like I don't want the extra risk without the cushion.
Right. So we want to create the asymmetric leverage, which we want to take that, get that opportunity to get a nice pop on earnings, because you can get, let's just say, you know, the implied volatility says it could move 10% in either direction. Well, we'd love to get that 10% pop, but we'd like to get it after we're up 20%, we're up 10%, right? So now we've cushioned the risk of our principal, but when we have the chance of extending our gains and having a really good profit. So again, once you get that cushion, you know, that's really the bottom line is position sizing, cushioning, and then looking at implied volatility, the history of the stock, to see what kind of volatility you've got there, and that'll give you an idea of, you know, what kind of risk, how much you might have to take off to finance the risk. Again, position sizing, you know, and profit cushion is really the only ways that you can reduce the risk. You know, you could, of course, hedge, puts, short against it, all that stuff, but that adds risk. That just adds risk. But once you're at that, you know, if you have an 8% stop and now the stock is up 8%, if it goes down 8%, it's not hitting your stop anymore, obviously, right? And if you sold part of it, you would cushion it even more. So just the fact that it's up is going to give you some headroom. And if you finance some of that risk and you take some off prior to earnings, well, now you've given it, it can go down quite a bit and you're still not going to lose much money. These are just some examples of that. Now, the other thing is you want to be careful about, you know, we're talking about risk, and some people, they become such sticklers with risk, which I'd rather see you be overboard with the risk mitigation than going overboard and allowing too much risk. I would definitely like you to start being more risk adverse if there's any, you know, leaning to any one side. But you got to be careful about choking off the trade. And this is where I'm talking a lot about math here, but it's not just math. And I talked a lot about charts, and it's not just charts. It's using the two together. All right. When we talked about confirmations and violations, and we're talking about the math here. So let me give you an example here. In this case, you break out of this cheat area, right? Now, the stock drifts off. You get 3 lower lows. That's a violation, right? Okay. Closes below the 20-day and the 50-day. Those are violations, but it's down 4.25%. Let's say your stop was 8. Well, it still hasn't hit your stop, and it's building a nice little right side here. So in this case, I would be maybe I take some of it off, but I probably wouldn't sell my whole position here because it's still acting pretty good. And now I'm coming to that where the rubber meets the road. Those, remember, 3 lower lows. After you hit 3 lower lows, 3, 4 lower lows, that's where you want to see. That's where, if the stock is healthy, you usually get that, you'll get that support, and comes in right on schedule. So if you were to come in here and start panicking out because you get a few violations and you're down 4%, and you circumvent your original stop, you would have got knocked out right before bang, it takes off here. And this happens a lot, where people will choke the trade off and they just get too tight on it. And the general rule that we were trying to tell you before was that that's why, if you're cognizant of the math, and now your average gain is X and you get above the average gain, you again, reference points. Remember, I talk about reference points through this whole thing. It's all about creating reference points and understanding what's normal, what's abnormal. You don't know what's normal or what's abnormal unless you have reference points. Well, I can look at the chart here and see that this chart is actually looking pretty good here. Even though I've got these lower lows and I got a couple of violations, it hasn't really fallen apart, and it has not hit my stop yet. All right, assuming my stop is 6%, 8%. Okay, now here's another one here. You come out of the cheat area, you come back here, you're just simply building that right side. You're building that next pivot. Once again, 3 lower lows, you get that supportive action on that last lower low, gets a good close. See, the stock only traded down 3.5%. So you should not be panicking out of this. This is not acting abnormal at this point. This is, would it be normal for the stock to come up into the old high, run into some supply, and then form that last part of the VCP? Absolutely. That would be absolutely normal. So again, knowing that, looking at the chart, looking to the left, seeing the supply, how many violations, what percentage you're down, bringing all that together gives you a full picture now. And now you can start making intelligent decisions based on probabilities, based on supply demand, not just on emotions and just, oh my God, I'm down $2,000. This is where Mark was saying, I said, is it any different now? You're trading tens of millions? No, it's not. Why is that? Because we've got all this data, all these things to help us remain disciplined. The rules create discipline. Okay. All the rules that I'm giving you are sound, tested, battle tested, and have succeeded time and time again through cycle after cycle after cycle, and have been duplicated with hundreds and thousands of other traders. I'm not the only one that can do this. This can be transferred to you. Now, another way that you can, if you're one to choke off trades or you're in a volatile market, first let me say my stop placement, and Mark, I'll let you tell us what your stop placement is generally, because I know you've got pretty tight average loss. Real tight for me is like 2 or 3% would be like super tight. Any less than that, I'm absolutely choking off the trade. Even 2 or 3% is really choking off a trade. Sometimes I just try to get it just right. The stock starts taking off, and I'll just put a stop at the day's low. But generally speaking, I average 4 to 6%, close to 3 to 4% in really great markets, 6%, 5-6% in tough markets, right about in the middle most of the time. My maximum stop or loss that I want to take, my maximum is going to be in the 7 to 8% range. 8% is my bottom line. My uncle point for is 10 to 12%, but that's only when we do staggered stops. So a staggered stop, as a matter of fact, I had a friend call me today. He might actually be on this workshop. I think he's taking the workshop. Called me today and asked me about setting a 4%, a 6%, and an 8% stop. So what I told him, I said that doesn't make sense, right? If you were to have a 4% stop, a 6% stop, and an 8% stop, what would your loss be? If your loss would be right in the middle, right? You total that up and you take 4 and 6 and 8. And you total that up, you divide it by 2, it would be the same loss as if you remove that stop in the middle. If you remove that 6%, you just had a 4 and an 8. Now you take 12 divided by 2, 6%. You still have that 6% loss, right? But the difference is now you're cutting off, you're letting the stock come down, you're choking it off, you're taking off 2/3 of your trade when you can have 50% of your trade on and still have the same exact loss. So with staggered stops, what I'll do is I'll stagger the stop sometimes around where I want to be. So if I want to be at 8%, if that's my normal stop, well, I can set a 6 and a 10. I could set a 4 and a 12. I mean, you can do whatever numbers you want. So I can choke part of it off, and then I can give, the more I choke it off on the first half, the more room I can give it on the second half. And so what I'll do this sometimes, and again, Mark, I want you to talk about your stop losses, how tight and so forth, and also anything that you can enlighten us about staggered stops. If you have any general rules of thumb, I generally don't go more than a 10%. Sometimes, on rare occasion, a 12. But that's usually my range for staggered stops. Is I'm going to go to 12. And that's because if I go much more, then I got to go, have 2% stop, and I'm almost guaranteed to get stopped on the first part. But you get the general idea. 4 and 12 gives you the same 8% as 6 and 10. Mark, any general rules, and also on your own stop placement as far as what's tight, what's what's your
Sure.
larger?
And generally, I'm in the same range. Usually not tighter than say 2 or 3%, and then I don't usually go beyond 8 myself. But the one thing I would say is, you always want to be thinking incrementally, because as Mark was saying before, this sort of ensures that you're going to be trading, your biggest when things are going best and smallest when they're going poorly. The one thing I would add though is, and I tend to be in that, sometimes choking things off too quickly. You want to also, with these techniques, have a plan for adding it back. So you showed that Vertex example a few slides back. That's a classic example then, where you also want to ask yourself, if the chart isn't souring, should I be choking it off? Even though, if you look at this, of course, my eye goes, well, this isn't, it had 3 lower lows, but they're really tight, and the chart's still kind of forming. But even if I were to sell a piece there, maybe as it closes below the 20, which I often do, that would be one. If the stock breaks out close below the 20, I've seen, which is right in line with Mark's research, that often that's a little bit of a red flag. But this is barely below it. I'd have a plan though to get right back in if I can, or if the stock then puts in maybe a quick tight day or two or a little bit of a reset, you add that piece that right back. And one thing just to let folks know, even everybody likes to start off, I feel like often, I just want to be all in or all out, and staggered stops, even more so than anything, I think helps people get the feel for how to trade incrementally and trade around positions. And that really is, to me, the hallmark of a professional, is somebody who can learn how to trade around their position and be incremental.
Yeah. And so what Mark is saying is that, maybe he gets these violations and he takes part of the trade off, right? And instead of having to make an all or nothing decision, but then as it turns back up and it acts normal, where he gets that support where it should, the train should come in schedule there, then he can always add it back. All right. So now let's show also just conceptually here. And I think you guys probably got this by now, but here's an example of ISIS Pharmaceutical, where again, this is one where I actually bought here, and I got stopped out of it here, and I did not come back into it. It's one of the reasons why I use this example, and I don't remember why. The market might have been crappy. Sometimes I'm just getting beat up and I got a bunch of losses, and I sell. And again, it becomes something else, comes into my trading, some other influence. In this case, I did buy this here and I did get knocked out of it. Now, if I had set a 4 and an 8, I'd still be in half of it. And then, as Mark said, maybe I added back here. The real mistake that I made was not adding it back, even getting stopped out of the whole position. As soon as it took right off here, that day right there pretty much said that was, I got shaken out, and that was a nice drifting handle there. It was perfect. I didn't add it back though. So again, you understand the concept, and these numbers, you're going to bracket them around where you want to be, and that will help you, stay in the trade. We're going to take another short break. Just 5 minutes, and then we're going to come back and we're going to talk about
Okay, guys, that is the end of the session. We're going to take a 5-minute break here. I would do some jumping jacks, get up, do some push-ups, get the blood pumping. When we do come back, we will be doing post-trade analysis page 475, catching up from where we were. Stand by. We'll see you in 5 minutes.